We're on mute. Couldn't do the last session without it being on mute to start with.
Speaking of strategies, you can guarantee you're going to be on mute every time.
Exactly, there you go, you spotted a pattern. I'm going to do this on one of the courses in future, just purposely wear a certain thing every day of a week, or have a week where I wear a shirt, a week where I wear a t-shirt, a week where I wear something that has a repeating theme in it, and see if people can spot the pattern. Anyway, that'll be a good test for people in future. I just don't think about these things enough. It's a great idea like the first week and then you forget about it. But initially, sorry, we were just discussing the idea of currency impact on equity markets and around when currency does or doesn't. So the example being the euro in Germany, and so the euro and the DAX. Theoretically, a weaker euro is good for the DAX because Germany's a big exporter. If you are a big importer of things, then you would weaker euro is good for the DAX because it means that German products are cheaper. If you are a big import country, you want a stronger currency because that buys more stuff in other countries. So the equity market theoretically moves off that. However, and this is an important point, that would relate quite well, so the sort of basic economic theory of it would relate quite well to something like, say, the FTSE 250, the MDAX, the Russell, because the companies within those indices are very US, UK, German-centric companies. Prime example of this was post-Brexit. You would think, well, Brexit is bad for the pound, which it was, bad for the UK, bad for FTSE. FTSE did the opposite. The FTSE goes straight up on it. The reason being, the vast number, or the large majority of FTSE companies are international. There's a big mining component in the FTSE, so they're earning all of their money in dollars. So the pound weakens, their profits basically just jump 25% because they're earning dollars and their dollars are now worth a huge amount more. So whilst you would assume the FTSE would go down, it actually just goes up. And you had a period for about 6 to 9 months after Brexit, where basically whatever the pound did, you could just click the opposite direction in the FTSE and it went. And that became a trade for a while. That any piece of UK data, the FTSE was a great trade on it. So let's say you had UK GDP comes in higher. What you'd get is the FTSE would jump, the pound would jump, and because the pound jumps, the FTSE then goes down. So you had a real simple trade that as soon as the FTSE moved, you would just fade it and you had loads of time to do it. What happens over time is that jump becomes less. And so rather than it trade up and then you had about a minute to fade the FTSE, what would then happen is the pound would jump and the FTSE would jump and instantly reverse. And then that then phased into the pound would jump and the FTSE just goes straight the opposite direction. So you have to kind of see the cycle of that type of pattern, which is part of the idea of the sort of strategy life cycle idea. So that's kind of the relationship, currency to equity. The thing nowadays is companies are so international that a movement in local currency doesn't have that much impact because of where most companies are earning their money, multiple different countries. The stock market actually is not a particularly good judgment of the economy. You look at the US economy and you can't say that it's thriving at the moment and the equity market's up 20%, just over 20% this year. You look at it since COVID, how much better is anybody's standards of life since COVID? Not particularly, and the S&P's nearly triple in value. It's not a particularly good judgment of the economy. It's a good judgment of inflation and asset values and people's willingness or ability to just park money in assets. Great for showing that, not particularly good indicator of the economy.
Would it be a good judgment of the wealthy?
Well, it's a guide to wealth, if you will. People who have assets are significantly richer now than they were 4 years ago. So yeah, but how that really does anything for you or what that helps you understand about the world and the economy isn't a great deal. Apart from there are rich people and rich people have more money. That's as old as the hills though. It's very easy to make more money if you have money because you can invest it in other stuff, and because you can invest enough money, the scale of growth is sufficient, and then you compound that, etc., etc. Right. This session was predominantly about getting people's strategies up there, going and having a look at a few of them. Not loads come in, that's fine. I appreciate not everyone's necessarily got a sort of strategy or a playbook trade that they can articulate or want to share. Fair enough. I've got a couple of ideas or suggestions on how you can start generating trade ideas, because that's ultimately really important. One of the things that I think people struggle with is the when to actually do these things.
So every trade you take should fall, you have a playbook of setups, and every trade you take should fall into one of those setups?
Broadly, you think of your sort of setups, and this perhaps where I didn't manage the explanation that well. The distinction between a strategy and a setup, as we were talking about a minute ago. The strategy being generally, this is what I'm going to try and do, this setup being, this is how I'm going to do it. But yeah, every trade really should fall into a sort of playbook type setup where you can go, I know what I need to do in this situation. Otherwise, everything's going to have a little bit of nuance to it, but otherwise you're just generally going, well, let's see what happens. You know, I'm just trying to think, let's say you're cooking something. You've got the ingredients, that's the basics of the price, etc. But you know that you need to do things in a certain order. You know, if you're making bolognese, you cook your onions and your garlic first. The nuance comes in how long you cook them for, and that's not a definitive time-based thing. That depends on your pan, the heat you put under it, whether you stir it, whatever. That's the nuance. That's the bit that goes, well, I can wait a moment here, I have to pay up, I don't, you know, that side of it. And then you go through the next stages of the setup and you end up with bolognese. Or you end up with a mess if you don't go through the right process and you just go bung it all in a pan and see what happens. It doesn't turn out how you want.
And if you don't have the structure around it, then you can't deliver it consistently.
Yeah, precisely, yeah. Yeah, that's also a very good point. Like the idea being that your bolognese should turn out pretty much the same every time. And if you're haphazard in what ingredients you put in, what order you put them in and how long you cook them for, you're not going to end up with the same thing every time. And that's what the goal is to try and do. But the thing is, even like a professional chef, I know this is getting a bit tangential. The idea is you don't become a professional chef by understanding how to do these things. So, and this is one of the things is explained quite well in The Art of Learning by Josh Waitzkin about the whole idea that people who come across as completely proficient in something or expert in these things have ultimately learned all of these structures. And because you've done that in so much detail over time, you just know how they fit together and it becomes intuitive. But it's not because they've got some kind of magical type of skill set and it's just innate. It's the fact that they've gone to the effort of putting together strategies, working out how you do it. And the more and more times you do it, the less and less you actually have to think about what comes next in it. Yeah, if you compared me and Mike playing guitar, it's a great example of that. I would have to think about what's coming next, and Mike just knows from listening because he's done it so much. We're not going to have me and first Mike guitar off though. Right, that's not where we are. That's also not where we are. Sorry, I went a bit too far back. Darius sent one on. Okay, I'll answer your one in just a moment, Darius. This was one sent in, so I haven't actually read through this in huge detail. So what I'll try and do is we'll have a look, and what I'm always trying to think when anyone presents sort of a strategy, particularly if it's sort of explained like this and there wasn't any sort of visual with it, is to then go, okay, well, could I summarize this, and could I, one way of doing it is, could you draw it in the sense of, could you go, right, I want to see this, execute. That would be the aim. So it's a momentum strategy. Oh, bloody pen. Momentum-based strategy. Sorry, my pen's decided it's not going to work today. I blame it on Thanksgiving. The Americans have given up and gone home. Which, to be fair, incidentally, that's probably what most of the traders have done. Certainly, anybody that I was speaking to yesterday was of the view they're coming in for the European CPIs, and that's it. When I first came in, I went and got coffee, and one guy was putting his bike helmet on, and he was off. So, yeah.
So European markets will be quiet?
Well, yeah, all markets go quiet on Thanksgiving. So what you'll usually get is you get the European morning. So you get the action happens in the European morning, whatever the moves are, whatever the news is, etc., etc. And then what you'll end up with is volumes decreasing. Yeah, well, if you look, that blue line there is the average volume per 5 minutes. So yesterday, big volumes at the open, and ultimately we ended up going nowhere. Today, you've got a spike of volume on the German CPI data. Big spike of volume on German CPI data, but apart from that, you look at that blue line and we're struggling to touch it. As the day goes by, you will get further and further away from that. You know, realistically, by probably about midday, most people in Europe have decided it's time to give it up, because you know that the Americans aren't coming in. So you know the T-notes aren't going to move. You know the equities aren't going to move. There's no data. And also all the US markets shut early. You know, it's only the futures that are open as well. So the futures will open for about 3.5 hours, and that's it. So you know that's coming. nobody bothers past midday. And because nobody bothers past midday, that makes less volume. So anybody who was thinking about it definitely isn't going to trade, and it becomes self-fulfilling. Right, penny's working now. Let's get on with it. Right, it's a momentum trade in Bund. Goals to be an early participant, directional moves, capturing clean part of the move as it's happening. Okay, so this is high or low of day. It's a LBN continuation. So passive entry at a price closer to the LBN that's still traded higher volume. Stop behind the LBN, usually 45 ticks. Chance to close earlier prices fills that out and spending some time there. Okay, so my take from this initially is that's the previous high. You're waiting for it to jump through it, create a little pocket of low volume and buy it off the top of that. High conviction trades second, third reference point, normal trades in next reference point, stagger orders to exit across target zone as it doesn't trade through fully. Okay, yesterday's high low profile levels, swing point levels, conviction, velocity on the ladder. Okay, so yeah, I can see that. It's kind of, it's a strategy around it's a breakout of previous day's high. This is probably more what I would describe as like a setup. Yeah, this is the criteria to go, okay, break yesterday's high, I'm going for it, and I'm looking for that jump, play the LVN, and then you're going to have targets above. What I'd be looking for, or I want a bit of clarity on, is what exactly would constitute these second and third reference points. Like, where are these coming from? So there's then a few other sort of considerations, I would say. Break of a higher time frame level, an hourly or a daily is a chance to pyramid. Add on high conviction trades on later LBNs being left. Okay. Stop a total position could be a place behind LBN. Okay. So yeah, I think you've got a sort of general idea of how you're going to do it. The thing that I would try and bring in on this is, one, what are these? So what defines them? And also, I'm going to assume that you're probably not going to do this on the break of every high and every low of every day, or the break of yesterday's high or low every single day. So the main question to make this a strategy rather than just simply a setup as a way of doing something, because you could use this once you've broken out, once the move's going. You know, it's a way of executing and a clear sort of definition of how you're going to place your stop, all of that side of it. What you want to be trying to understand then is when you're going to do this. Like, what would make a high or a low worth playing the break of, and what would make one not worth playing the break of. That for me would come down to, sorry?
Fundamentals?
It's not, fundamentals don't bother me too much on these things, because fundamentals are going to move you anyway, and that's probably a trade you're taking based on the fundamentals. With something like this, what I particularly would be wanting to look at would be a situation where you go, okay, well, we've been sitting in a 3-day range. This is the one I want to play the break of the high or the low. Whereas if you're in a steadily trending or uptrending market, take the Bund at the moment, for example. If you look at the profiles in the Bund there, I don't massively want to be trying to play the breaks of the previous day's highs and lows. Yeah, you play that break. Yes, it might have worked. That one barely works. This one doesn't happen because it's a gap up. You would have got stuck playing this one, because what you're doing is you're playing breakouts in the direction of a market that is just drifting. So this would then not be a time to do it. This would be one that I'd distinguish the fact that you have gone up in reasonable straight line and it's stagnating up here. I'd be quite keen to play the break of the low because of what it offers you to the downside. If you break that low, I'd be quite surprised if you didn't get down into this little gap area. And if you do that, you're then looking for the move down into this low volume area below. So I think there's some value in that. That would be the bit that you want to try and bring in as a strategy around, well, when are you going to use this? When are you going to employ this type of idea? Kind of explains it anyway. Feels like just trading the setup, even though it's showing some results despite bad execution, and try and work out reasons when to stay out of trades. I'm also working on finding commonalities in structure before the bigger directional moves. I wish I'd read this bit before I explained that bit. Absolutely, and that would be the thing that you want to try and work on. What I would suggest on it, it's a demo, right? Use the demo for it and try and look at this and try and take them all on. You know, go for all of them, and then you can work back and go, well, that one works. Why did that one seem to work and not that one? So you've actually got the kind of information to go on the back of it. Otherwise, what you end up doing is kind of semi-back testing it and semi going, well, I fancy this one. And if it doesn't work, because you've discretionarily gone, yeah, I fancy this one, and it doesn't work, you're going to be much quicker to go, nah, that's not a good idea, don't do it. So if you have a go at all of them, you may find that actually, yeah, this is just not a good idea, and you prove it to yourself that playing breaks of highs in a grinding uptrend isn't a smart choice. Breaks of lows play quite nicely. So I think, you've got the setup, go and do them all, and then try and filter down the ones that do actually produce a result. What is a common scale of movement? What is a realistic next target? And that way you're able to sort of filter through a lot easier. So that's how I sort of go about trying to do that to start with. The other way of looking at it is to try and look at markets that have a sort of certain type of structure and start from a point of go, well, what do you think would already be a likely good structure for this? Like I said, this to me looks like a lovely one to the downside, but not a particularly good one to the upside. Nice balanced sideways action. That's not a great example. That one probably is, where you've been sitting sideways, 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 sideways. You can then play the break of this high and you get the directional move. So that would be a way to play it. Includes the breakouts of higher time frame structure as well as velocity of the auction, which often only starts to pick up after the market's already broken out of the area by some amount. Exception news-driven moves. Screenshots from the 7th of November. Bund was breaking the low of the day, leaving an LBN at 37 of November. Rich is saying later that some Axia traders are building big short positions anticipating the move. 7th of November was, yeah, that one. The play of the break of the low. This is a prime example actually, where you've got multiple sideways days. These are the kind of ones that you look at and you go, it's going to do it at some point. And this is where you're then much more ready to use that strategy. You're looking at that going, okay, great. If this takes the low, I'm much more keen to go for it. So that's how I try and sort of use these, try and distinguish these types of situations where you can play it. That's set you a pretty decent start there. Just go, right, if ever I get, and it don't count them and oh, it's got to be 5 days. If this had gone on this day, there's not going to be people going, well, it's not done 5 yet. People are still going to go for it. It's the structure that matters, particularly when you've got these kind of ledges here. I like that type of scenario where you've got a low, some kind of other structure to break, like a ledge or another bad low in the same area that then presents the opportunity to go for next lows. These are the ones where if these are your reference points, sort of first, second, and there isn't really a third, you'd have to go way back for it. I wouldn't be getting out here. I'd be looking at this as you play the break and you aim to add on this break to get through there. And that would be your minimum kind of target. It's got to break that. That would be one that you have to accept that, if you're selling it through 36 and it doesn't break, so 17, 16, 15. If it doesn't break 15, you have to accept that, well, it's going to come back on me. That the goal of it is it goes 36, it goes 15, it keeps going. And that's the idea around it. So yeah, nicely done on that. Go and have a look at those types of structures and see if you can work them out. I'm just trying to find. Here you go. I've got a kind of example of this. I can share the link on this. Oops, where's it gone? There you go. This is one that I'd started sort of trying to note down, what I'd call a liquidation into a cave. It's a similar kind of concept that you've got this kind of double distribution lower, and I think I've got a few different examples of it. And yeah, another example there. So that's the only two, but I've seen multiple of these types of things. The idea of then this being a sort of additional structure around it, that what I'm looking for is this sort of 2 days of balance with a cave below, so that what you've got then is not just a strategy that is about the play and the break of the low, which you're then basically playing that little LBM break there. It's not just that, but because it's a cave, you've got clear sort of scope to the downside in it. Both this one and I think the next one had this kind of initial move and then this quite grindy move through the cave, which is another feature of it. So it becomes a trade that then, if you're looking at it, the onus goes on the early execution, the early and bold execution of it. What you don't want to be doing is messing around in this bit, trying to get more into the trade, because that's where you're going to get frustrated. If you don't get your execution bang on, your average price comes washing down here, and an hour after the initial entry point, you're now looking at yourself offside on double the size, and it becomes uncomfortable. The idea is still there, the strategy is still there, but you're now in a bad situation. So one of the other parts of, you take a setup like the one described, part of the strategy around this has to be about the sort of bold execution early on. The later you get into a move like this, the more trouble you're going to get yourself into. You're better off to go big and go early, and that way, if it is going to grind, these types of pullbacks aren't so tough if you're in from here. Yes, it comes a fair way back, but you can still sit there and go, I'm still on side. I'm protected by that low volume that's created here. I'm all good on this. But if you try and sort of limp into the trade and gradually build, what you end up with is this kind of wash back on you. It becomes really uncomfortable, and ultimately you won't sort of play that full move out.
And also when you don't like fully commit to the idea, to the trade at the start, and then you're trying to do it, you're not actually fully committed with your mind to the idea at that point, are you? Right? Because you're still kind of into your mind, and therefore you interpret, there's a risk you interpret any price movement with extra disparity, because you're not clear on, I've committed to this is going down, that's my trade plan, I'm leaving it.
Yeah.
The setup, I'm leaving it. It's like it starts coming back and you start second guessing yourself because you haven't committed to the idea up front and then got in later, which affects your commitment ability.
Yeah, no, I completely agree. And it's definitely that kind of thing that, it just becomes easy to doubt yourself. The reason people don't commit to it is it's uncomfortable. If, like, let's say you normally trade in 2 lot clips, it's uncomfortable to go 6 lots immediately, just sell 6, because that's not what you're used to. You normally do a 2, and to sort of go on this one, bang, 6 straight off. And so you're looking at it going, if this comes 5 ticks back on me, this is going to hurt at least a lot more than normal.
It's actually good risk management because...
Precisely. That's what you have to sort of, as you get to that situation, you're like, well, I don't really fancy 6. You've got to look at it and go, if you do 6 here and it goes wrong, the cost isn't going to be that bad. Call it €300 probably, not much more than that. If you make it 6 by the time you're down here and it starts washing back, you're not going to know you're wrong for probably 10 ticks. So now it's a much more uncomfortable and bigger loss. So that,
profit as well, like,
yeah,
you could be able to get another 6.
precisely. Yeah, that is the point where you've got the greatest payout and the smallest cost of doing the trade. If you're getting anywhere else, the cost of doing the trade is going up and up and up, and the payout is going down and down and down. So it makes sense to go, well, if you're going to take the risk, just do it up front. Some trades not the same. Some trades, some trades are trades where if you're getting in, not a great example of it in here, but if you're getting in like in the middle of a kind of range and you're waiting for it to go, you don't want to put all your size on that, because you know that you've got a situation that always could go wrong. So you go smaller there with the view that you're going to add once you break. If you were, it's not really a kind place to do it. If your idea was to try and sell it up here, like yesterday's closed VPOC previous highs, if you'd managed to get in up there, that would be one that you go a bit smaller with the view that then you can hit it through the low, which is also another variation on the strategy. That would be a lovely entry to take up there. You get in, but you don't go big on that, because, well, if you get filled here, it might be a day that actually is just going to open trade through value and you're going up there. So you don't want to go big on that, because you haven't got enough information to know you're right, but you've got enough information to know that you've got a nice position, and if you are right, there's huge scope to add.
As soon as you can identify your stop, that's when you can just have fun.
Well, your stop hit in this trade is just above that VPOC. You look at it and go, brilliant. If I can sell that, the added bonus of doing anything like that, which is always a nice thing, if you can sell it there, this has got a huge range on it at the time. I didn't realise Bund had got ranges quite so big in early November. Oh, this was post the election. You're going to be, by the time this breaks the low, best part of 35 ticks on side. Your ability to add on to that through the low is huge then, because even if you go and sell into the low there, your average price is going to be there. It shouldn't come back on you, and even if it does, you still got 15 ticks to your average price. You're still taking a 10 tick winner out of it on the total size that you've got. So
when adding in, Rich, is there a percentage of your main
position
size that you should add to make it worthy, or is there like a certain amount that's just going to throw your P&L like not worth, like it's going to actually do damage to your P&L?
Nothing's going to do damage to your P&L if the trade works. The general rule around it is don't add more than the current position size you have. So if you've got 2 lots in, don't add 10. Pulls your average price down. Theoretically, if you're adding to the trade, you're already getting in at worse prices than you were. So the question is, well, what's changed to make this now a far better opportunity? Maybe some circumstances. And if you're going to add 6 now, why didn't you just do it as half of that to start with? So generally, if you 2, you add 2, nothing wrong with then adding 4. but you are still sort of skewing if you sort of visualize where your entries are, you've gone 2, 2, 4, so you become a bit bottom heavy.
You've got to go in like 10 and then adding like a quarter of your position, a quarter of that main size.
I think it's always a discretionary type of thing. I would suggest you at max double up. I wouldn't want to be, what I don't want to do is if you're in 10, I don't want to add 2, it's pointless. You either add at minimum 5 or you just add another 10, but I wouldn't really want to go and add 20. There may be certain, something like this one where you've got yourself a nice position here. This is the moment that it should work. So this would be a trade that you probably should go a bit more. Yeah, that would be the exception to the rule. Yeah. Try and look at it like this, right? That's a trade in itself. It's a passive entry. You're going to try and sell it for that. That's one trade. The other trade is to play the break. Now, you could look at that and go, well, if somebody offers me this trade and only this, I want to do this with perhaps a 2 or a 3 lot because there's lots of ways that this could not end up working. If I get the chance to do this, I want to do this with a 6. So if I'm given a chance to do both, you do that with 2 and that with 6, and that's the trade. If you're going to do that, what you have to be able to accept is that if it goes wrong, chances are you're going to turn out with nothing on the trade because your loss on the 6 will cancel whatever you've made on the 2, and that might be quite sort of uncomfortable to take.
Where it's easier if you have more size, like, because you could just kind of scalp out your first position and then add it, like.
No, because then what you're doing by having more size and scalping out of one and then adding back in is you're reducing the overall value of the trade. So when it goes wrong, it just goes wrong on more size. So that's why I always said, think of it in terms of clips. If you go, right, my max size is 10, therefore I have 5 clips of 2, that's the same as 100 and 5 clips of 20, 1,000 and 5 clips of 200. So you do the same trade in the same way every time. This would be that's a 1 clip sell, that's a 3 clip sell. It doesn't matter, whatever those multiples are, whoever you are in your career, it's the same trade.
Do you do half clips? Is that a thing?
Why would you do a half clip?
Or just maybe if you have like a strategy where you want to get a passive entry, so you split your clips in half. My
suggestion on a half clip is you don't believe in the trade enough, so don't do it. That's the simple way of viewing that. If you don't think this is worth a full clip, you're not convinced this is worth doing.
I mean, it's hard work with just like 10 lots. It's not hard. But
I wouldn't say so.
It's just, I don't know.
Divide it by 5. Trade in 2s. The best trade you can see for the day is worth all 5 clips. A entry that you know needs more information to become an actual trade is a 1. Something that is quite clear is a 2 or a 3. 4 is probably where you've hit a 2 or a 3 and then added onto it. There's not many where you're going to go, this is a 4. It's good, but it's not amazing. It's either great or it's not. Go for it.
The other thing also about averaging down, I find, is that you then change your psychology of your trade management, right? Because if you average down too low, then from having been relatively well on side in a nice, comfortable psychological position, and then you average down too low, you then put pressure on yourself when the trade is then moving around your average down price, which changes how you manage the trade, which ultimately affects your profitability over the long term, or can do when you're still learning. Massively. Yeah, because your P&L fluctuation becomes so much bigger straight away. If you're on a 2 lot here and it ticks back 5 ticks, it's 100 quid. When you've sold another 6 here and it ticks back 5 ticks, it's 400. So your P&L fluctuates that much more. You have to, that's part of, with a trade like that, part of the sort of strategy setup, however you want to term it, is the planning in your mind that at some point this is going to feel a lot more volatile P&L wise, because it's going to go tick, tick, tick down and your P&L jumps up and very quickly it evaporates. You have to sort of almost visualize it, just get in your head, like, what's this going to look like when I've got 8 lots short here and it does that pullback? That pullback's pretty vicious. That's about 25 ticks. So if you're on 8 lots, what's that, 825 is a 200 tick pullback. It's $2,000 pullback on your trade. But you're still on side quite nicely.
If the price action is not showing you any different, it's an opportunity to add in if you want to look at it from the other perspective.
That's the way you've got to think about it. And that's part of trade management, where you're in the trade, whatever size you're in the trade on. One of the best ways to sort of think about it is, if I had no position here, what would I do? And if you had no position and you weren't trying to sell that, which is the pullback here, you've got to question what you're doing. That's a sell. You may not get filled. If you didn't have a position, you might be a little bit more bold to go, right, I'm not in, I'll sell 9s just to make sure I am. If you've got a position, you probably won't add to it, which you can debate whether that's logical or not. But you have to look at it. It's a good way of trying to keep yourself in a trade. Just always ask yourself, if I had no position here, what would I do? And if the answer is sell, well, at minimum, you don't get out and you probably should sell. If the answer is I buy it here and you're short, you've got to then consider whether you should be scaling out or you should be adding to the trade. That was the actual trade, the move through there, through those lows. So you got a nice sort of head and shoulders, double top, whatever you want to call it, to play it with as well. But one of the things you go back over these is, sort of try and describe that type of a move as well, so that you know in future, when you take a trade on like this, if it does something like this, you at least can look at it and go, yeah, that's what it probably would do. This, I believe, is this, I believe, may well have been the Bund option expiry reversal. Yeah, it could have been. There's quite a pattern of that for a while where the Bund would just drive up on option expiry day and the next day it reversed a whole lot. So that became a bit of a theme. But there you go, I've shared that one, so you've got that to have a look at. Okay, this is another one that got sent in. I'll try and answer Darius's one. Replayed after the live session first week on the 23rd, got chopped up badly after the open. There's a similar area later on in the day as well, which I'd like to get chopped up in. There's a couple of nice breaks between these, trade 1 and 2. Okay. 1 and 3 were decent and didn't try to stop on 2 and closed out at first resistance since it looked like it was becoming a balanced day. Playing for a break in the center of the range was likely to have limited scope. Do you have any points on how to improve? I'm assuming I should be a lot more selective on breakouts. There's a good chance that we have, when I believe there's a good chance of balanced day. I've checked what occurred on the break versus false break and nothing's jumping out. Okay, yeah, number 2 strikes me as a trade that the improvement there is to look more at your chart and go, well, where's this going? Surely you've got to look for that high. I'd suggest on number 2 that to me looks like a trade where you've got in and gone, oh, I'm not sure, let's get out. The classic, the price action didn't look good. Well, it's probably not going to look good if you perceive this to be a balanced type day, which, let's face it, it's gone up, it's gone down, it's going back up. It probably is a balanced type day. The price action is not going to look great in the middle of the range. And if you are playing a move like that, you have to just look and go, it almost becomes a chart trade where you just go, the chart says this, it's going there, and either it does or it doesn't. And there's not a great deal of feedback you're going to get on a ladder in a trade like that. What intrigues me about this is this one, I don't think you should really get too chopped up in. This one I can definitely understand how you do, because it really doesn't offer anything. But one thing I would suggest here is you probably don't want to be playing directional trades in the middle of range. That would be the main sort of strategy improvement. If you perceive this to be a balanced day, you have to sort of step back on the idea that of sort of going, well, I'm not going to get many chances today. This is very much going to be a day where I'm going to wait and wait and wait. You've got the previous low there. If you can find a reversal here, this is where you have to have a setup, a playbook idea of, well, it doesn't get to the low, so you can't just buy the low. How are you going to play this trade to the upside? This little block I would see as the trade to play to the upside. You've then got the previous high. Have you got a strategy around that? Personally, I really don't like just selling the previous highs, because these are the types of trades, and this would be one, if you're doing it, is a smaller clip trade. Because there is nothing about a previous high on a neutral balancing type day that suggests this must come off, at least in any kind of pace. So if you sell it here, there is nothing to say, as this proves, an hour later, 2 hours later, you're not going to still be watching the market just rotate around your price. If you're comfortable with that and you're happy to go, yep, I don't mind just being in, it's going down and I'll wait, then fine, do it. If you're not comfortable with that type of thing, then you've got to have a strategy around how are you actually going to play this? This little break here, I would be trying to play the break down there rather than trying to just be short at the top. Because for me, they're just really uncomfortable trades. And what would end up happening is, I'll sit there with a small position, get bored of it, and we'll do one of two things. Either try and scalp the small range and try and eke something more out of it, which generally isn't a great idea, because you're trying to play for like 2-tick winners and you end up just round trips, not really achieving a great deal. What also will probably happen is, because you're so bored of the trade here and so keen to get out, probably won't really add there. You won't commit to that because you just become sort of worn down by nothing going on. So I'd prefer to always just not be part of it and just go for that with 2 clips than I would to try and be in 1 here and then add 2 there. I think you just end up getting just bored out of the trade. And part of these neutral types of days is the acceptance that quite possibly you're not going to get anything to do for the day. You get this one, for example, where it goes back down to the low down here. You could buy that and you end up basically timing yourself out, that you're buying it there, you're maybe 15 minutes away from the close. You're not getting out there because it's not done anything, but you also know that it's probably not going all the way back through the range. So you end up long and maybe a 2 ticks on side, but you end up timing out on the trade, and it just becomes one of these types of days where you basically don't get offered a great deal. That for me was probably the best opportunity to play it up there. I could see why that's a sell there. I think that number 1's probably a decent trade. 3, it's all right. I'd be interested to know, and this is the thing you probably want to go and ask yourself, what was it about that end, or what got you in there compared to anywhere else within the move? I'm wondering if it's that little sort of kick down in delta that something happened and that was the reason to get in. Yeah, with a trade like that, if you've seen something there, they're quite nice because you know where your stop is and it's just above the high. It's an easy trade. Go, I'm in, let's just see what happens. As long as you're willing to accept, and this is the other thing with neutral day, that we could just do this for the next 2 hours and it just, again, could end up boring you out of the trade. There's nothing wrong with that. So they'd be a couple of the ways that I try and sort of improve it, that if you feel that you're ending up with a neutral day, I appreciate you can't at that point, which is why that's a decent trade, because initially the goal here for me would be to go and break the low of the day. That's fine. 2, I don't like. That just strikes me as a bit of boredom. Oh, we're going up and we're in the middle of the range, I'll just get in, which, to be fair, you've got out of it anyway. 3, the thing I'd suggest on 3, if this is a neutrally type day, that's the middle of the range. That should probably be your first exit. I think that one, that exit there, that looks like an exit out of boredom, that you've sat there and sat there and sat there and gone, oh, just get out. I can understand it, but you want to make sure you get back in. Yeah, I'd almost more want to have seen that have been a sell, that you've got to the low and you thought this is the one, sell it, and then you end up taking a small loss on that rather than the other way around. That'd be the way to sort of look at that one. Right, that was it on the actual ones that people sent in. There's a few things that I'd sort of kind of put together as ways of trying to sort of work out different strategies. And there's a couple of different things. One, you can look at stuff that you know is going to happen every day. This is useful because, well, these are every single day. Stuff that you know is going to happen every day, because this makes your life easy in the sense of going, okay, well, I can try to trade this and this and this and this and this, and you get that feedback that you can compare that the next day, next day, next day, next day, next day, and it goes on and on and on. It also is quite, well, it's obviously time-based. So anything time-based is generally quite easy to work a strategy out around, because you know when the European Open is, so you know when you should be looking for something. The hard thing about broad technical trades is that, well, it doesn't have to happen now, tomorrow. You may not see it for weeks. And when you do see it, it doesn't have to work either. The European Open, for example, something's got to happen at the Open. Yeah, it opens, volume will come in, something will happen. Whether it's tradable is different. But if you're tracking these day on day on day, you will start to work out a sense of when it's worth going directional at an Open or not. I would suggest that a lot of the time the answer would be no, but you'll work that out. Initial balance breaks, what is a good situation, in which time you want to play the initial balance break? European data. You go through all of those different phases and all of those different things, and you'll then start to pick up some patterns in them. So that's usually a good starting point. And just if you're going to do it as like a table of information, just start to try and track the information, get down the relative position. When I say relative position, I mean where you are opening compared to the previous day. Whether it's inside range, outside range, all of that side of things. The direction of it, so whether this is straight line, up, down, sideways, whatever. The size of the move, whether it sustains the move. So you're trying to get a sense of sort of what is worth looking for. There's no point in looking for 100 tick initial balance in the Bund on every day. But if you have a situation where it opens gap down on news below a significant daily low, 100 ticks on the Open quite possibly is on the cards. So you start to sort of understand the situations in which these types of things can happen. Whether it sustains direction, what the planned trade is on it. Even if you don't trade it, you can at least come up and go, okay, well, what would be the idea here? And then what's the result of the trade? It's just a simple way of trying to sort of work out where you've got some kind of edge or what might be worth having a go at. So that's one approach to it. With something like this, you'll pick up a lot very quickly as well. That's why I think these time-based things are a good place to start for a lot of people. And the kind of thing that a lot of people don't look at, particularly closes. People don't look at closes very much at all. I don't know why that is. Perhaps it's that people just didn't know that much goes on a close, but there is, every day you will get some movement, you will get volume on a close. How much volume and what precisely it does, don't know. But what you're trying to work out is with these closes, what happens, what's the criteria for a good close? And once you start to sort of see, okay, I'm finding stuff in one of these, then you can go and look into that more detailed. What's the volume like beforehand? What's the direction like beforehand? At what time does the move start into the close? That kind of information to sort of focus down on that as a strategy. This would be something to try and just understand, well, are you finding anything? Because you may look at it and after a while you decide that there's nothing to be done on Treasury opens, just forget it. But at least you filtered that down, at least you kind of worked out. If you just did this for a month, you'd end up with a huge amount of information that you could then go, okay, well, I can at least roughly say I don't need to bother with that, but I've got something, or I've found something that I can work on European data, oil opens, European closes, and if that's it, then you can dig into that a little bit more. So sort of trying to provide yourself a bit of sort of framework to work towards or work from. The other thing to do then in terms of strategies is take certain types of day and try and split them into phases. Liquidation day is a prime example of this. What you would describe as phase one and what would be the kind of setups that you're looking to use. Phase one of a liquidation day is the break, the initial break, the fast straight line move. Phase two of an of a liquidation day is going to be the pullback and the balance. Phase three, some of them won't have one. Really a liquidation day has two phases. It has the rip up, the pullback and the bounce, and that's it, and then it becomes a neutral day. So how do you play these types of things? Same with a neutral day. Ultimately with a neutral day, phase one of a neutral day is you're playing this to a degree directionally, because you'll start here, and let's say it does that throughout the day. Phase one, you ideally got a reason to sell here. When you sell there, this could be anything. This could be a trend. It probably isn't a liquidation day, because liquidations usually go in that direction straight off. But you sell that, once you're down here, now you know it's a neutral day. And there may be situations, if this is inside of a cave type situation, oil yesterday, for example, you'd play that as the short and that as the long. It's a terrible drawing. So then that would be phase one, phase two. Phase three would be if you get another chance, but the phase 2 and 3 trade would be to go back to the middle of the day rather than to go to the other side. So it's trying to sort of work out what's the broad idea of what you're going to try and do, and then you can fit a setup into that as well. But again, it's a good place to sort of start of just building a framework around what you're going to do on certain days, so that you're not sitting there on a trend day going, okay, here's phase one, here's the breakout, the initial pocket of low volume, the initial sort of balance, and you're then going, oh, that looks a little bit far, let's try and fade it. You can go, well, if this is phase one of a trend day, the next phase is buy the next pullback, and onwards and onwards and onwards, and you don't get trapped on it. So that'd be another way to sort of just set out your ideas, so you can think, yeah, these are the ways that I play certain days. Some days you might look at a normal day, for example. Phase one is the large initial balance, which realistically you're probably not going to have much strategy around, because it's hard to know a large initial balance is coming, apart from an opening range break. After that, there are often days where generally my view is there isn't much phase two. Phase two is an unpredictable large range, basically. So the only sort of phase two part of that as a strategy for me would be about trying to find opportunities to take small scalps rather than trying to play for anything particularly big or directional. So at least if you just set that out and you go, right, I'm on a phase two of a liquidation day, this is what I've got to do. You can then sort of turn to your playbook and go, these are the ways that I can do it. And if you don't have many ways to do it, then you go, okay, well, phase two of liquidation days I need to work on. Phase twos of liquidation days, I just don't want to trade, for example, if you're not comfortable doing them. Because basically, a liquidation day is a very fast trend day and a neutral day, one after the other. That's what liquidation is. So if you're bad at trading neutral days, once you've got that first move out of the way, you move on and leave that market alone. If you're bad at trading trend days, you see that initial move, you're like, brilliant, neutral day now, buy the pullbacks and try and play it like that. So it's about, you want to try and work out where you're particularly good, and also what strategies you've got around or what sort of setups you would employ in that situation.
Yeah, I think based on what you were saying earlier, I can't remember what you said, of course, maybe a couple of weeks ago, you were talking about, the thing that I found helpful was in the open is instead of having a structure for the opening screen, the first 5 minutes, I've written down what is my job, what should I be thinking, what should I be looking for, then the first 30 minutes, then the first 60 minutes, to give myself structure around what I'm trying to be doing and executing, rather than sitting there watching the price action and trying to guess what's going on, but matching it to day, so I developing patterns.
Yeah.
The difference between an opening drive on a trend day versus a liquidation day, they're very different, and what should expect that follows on from that, right? So what's the second, as you say, the second place that you can get on those days, to try to give some structure, start with putting the pieces of the jigsaw together to make a new jigsaw each day, if that makes sense.
Yeah, exactly. So I think that's really valuable. That's a almost time bit, because you're going to get to a certain point, and some days it's going to trigger after 5 minutes. So you're like, right, I need to be selling. And other days you go, there's still not enough information. There's still not enough. There's still not enough. And there'll be some days you get to like 2 hours later, you're like, right, well, I haven't had any information to do anything with, but now I can at least roughly understand what the day probably is. Neutral day is probably that type of day where you're kind of semi-expecting neutral. You open in the middle of value, you don't get a great deal of volume, nothing happens. You mean this is neutral, but you're still at the phase going, well, I think it's that, but I haven't got any information to do anything with it. But I think, particularly opens, it's quite important to have that sort of structure, because then you get around the problem that most people have going, the flashing lights, click, 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 yeah, exactly, and it's all go, and it just, you feel like you need to be involved because everybody else is involved, at least in your head they are, they're probably not, and everyone else is probably thinking everyone else is involved, and it's your ability to go, yeah, but I've got a sort of structure. It goes, well, I haven't got enough to get involved here. Other people can get involved all they want. It doesn't mean they're doing the right thing. And that's the thing you've always got to remember. Whenever you get that feel of everyone else is doing something, or I need to do something, you're not missing out on anything. And if all you're trading for is the need to do something, it's not a good enough reason. It's just tempting to do. You got to kind of always remember that. But yeah, that's sort of, I like that idea of sort of, what have I got to think about at this point in time, and then have I got the information to do anything with? So yeah, there's a structure you could create there around just the first hour. And that would help people a lot with opens, being able to go, well, I can,
information justify doing anything in my plan, no, so then my job is to sit here and wait.
Yeah, and it makes your life a lot easier because you've kind of checked the boxes off and gone, well, this tells me to wait. So you're telling yourself via a structure you've created, rather than you having to tell yourself, which, it's very easy to go, nah, but I still fancy this, click.
Well, because it comes down to like the neuroscience of your brain, right? So your prefrontal cortex is where you have all logic and reasoning.
Yeah.
Your emotions are driven from your amygdala, right? Which is more powerful, is the thing, is the primal instincts. So the logic says, hey, I want to sit there, I want to be patient, I want to do this. But the flashing lights trigger the emotional response, the emotional brain overpowers the logical sense. So you say it's having that structure of something I can sit there and hold and say, this is my job, I've already told myself this is my job, I can not respond to the emotions that are being triggered from the flashing lights.
Yeah, it works the same with trades as well. Like the whole idea we were talking about with the putting the size on, you want to have a sort of structure that goes, well, if this happens and this happens, I need to hit 3 clips, and because the probability of this going wrong is now 20%, the payout is still 50 ticks. That's a bit that goes, you have to take risk. And when you look at the information, it kind of says that there is no reason not to. And that's also sort of gets around that emotion of, oh, do I really want to hit all 3 clips here? Do I want to see a 10 on the screen when I've clicked it?
I mean,
it feels uncomfortable.
Risk management, like you said, you have to do it because it will affect your underlying P&L at the end of the day. Like, you have to do it.
And that's what you've got to remember with risk management as well. It's about when to take a risk as much as it is about trying to restrict losses. It's about going, well, everything says you should take a risk here. Take the risk, because actually the risk of losing is getting quite small and the upside of doing it is very high. You have to take the risk. And again, if you sort of flip it like that and you've got almost sort of a checklist of stuff and it goes, take the risk, then you at least have something that goes, go on, then do it. Because you can then...
Not just randomly take it, not just randomly add it in just for the sake of it.
No.
And also having the objective criteria while you're doing something allows you to be consistent. Otherwise, how do you ever know, I'm just going to decide that this time I'm going to do it, right? And I'll do it, and I want it's successful, it's not. You don't have any way of, if you don't have structured criteria, you've got no way of evaluating whether the decision-making process is right or wrong.
Yeah.
In those situations, and how to improve on it.
And then you can't replicate either. You can't sort of...
I'll guess today's the day I'm going to do it, tomorrow I'm not.
Yeah, and that kind of, people say, oh, it's a gut feeling thing. I think everyone gains intuition, but that comes from a structure to start with. You've got a clear structure, and over time, you can't necessarily quite perfectly explain what you've seen, but you've seen it before because within previous things you've done, you know it. Yeah, but this sounds, I don't know, dismissive perhaps, that you ultimately can't have that gut feel if you've not done the previous, and if you don't have the experience, that gut feeling it can't be there. It's why you teach kids a clear structure as to how to cross the road. As an adult, you kind of go like that, and you know you can go because you've done it enough times. You judge the distances of cars and their relative speeds.
Still
But
the wrong way. I look right.
you look both ways. It always helps.
I always look the way.
But yeah, with kids, you set them out. There is a clear process to how you cross the road, and you wait and you look and you check and you sort of ask yourself, is it clear? Can I go? Yes, go. As an adult, you don't do that. It's just automatic. That's the same kind of thing, but you can't have an automatic judgment of a trade if you've not done enough trades. It's a great book worth reading. Someone asked me about books incidentally, so I'll mention this and we'll wrap up for now. Someone mentioned about books. A great book to read, and what I'll do is on the bottom of this sheet at the end, I'll put a list of books that I've referenced or I quite like. But a good book on that intuition type idea is a book called Blink by Malcolm Gladwell. It's quite nice. It's a nice, easy read because it's done in sort of short stories of different things. And it's about the whole idea that your subconscious can work things out faster than you can work them out and be able to articulate it. So, one of the examples they used was a game of betting on higher or lower on the next card with a rigged deck. So there was a clear pattern of higher, higher, lower, lower, whatever the pattern was. You got people to play the game, and people would increase their bets at a certain time on gut feel, and only later they could then explain what the pattern was. But your mind will understand the pattern and tell you why you should up the bet before you can really articulate why. So you can understand these things. That's the whole idea of, if you've got a trade structure, there will be nuances within that you don't necessarily know what they are, but there will be certain situations like, yeah, that's worth a little bit more. That's something that you probably won't be able to fully articulate or get into a strategy, and that's ultimately why you can't copy someone else's. Someone else's strategy is a broad gauge or a broad sort of idea of what they might do. You've then got to have that little sort of gauge within it for yourself of going, yeah, this is how I do it. But yeah, good book, worth reading. On which note, I'll wrap up there. 2 o'clock, I'll cover off any questions that people have sent in, sort of trading related stuff. It may or may not be a relatively long one. So yeah, if you've got any trading related questions, throw them in there. It is Thanksgiving, so I appreciate most of the Americans are probably off eating turkey anyway. Well, perhaps not quite yet. So any questions you want, throw them in. If you are in America, I'll answer them. You can watch it back later after you've eaten some turkey, drunk some beer, wine, etc. Right, I'll see you all at 2 o'clock.
Rich, is there a Fed tracker for the ECB? I don't think I've asked.
No. There is a